Long-term capital management, LTCM, a hedge fund founded by Nobel laureates, lost $4.6 billion in just 2 years. How did a company, gathering some of the world's finest minds, find itself pushed to the brink of collapse? In 1998, LTCM lost $4.6 billion, 90% of its peak assets, nearing a crisis that threatened to engulf the global financial system. But, in fact, this failure had a systemic cause: an over-reliance on mathematical models, a pitfall that continues to echo in today's age of AI and data science. What was the trap that led these geniuses to ruin? In this video, we will explain why these geniuses fell into the trap of success, who overlooked what, and what lessons there are for modern finance. Now, let's delve into the full scope of the LTCM collapse. In the main feature, we'll also extensively detail how the Federal Reserve saved the world. In 1994, long-term capital management, led by John Meriwether, was born on Wall Street. Among its executives were Merton and Scholes, Nobel laureates in economic sciences for their work on financial markets. They were trailblazing geniuses at the forefront of financial engineering, having paved the way for option pricing with their groundbreaking Black-Scholes model. LTCM's strategy was arbitrage trading, identifying slight price distortions and leveraging vast sums of capital alongside mathematical models to profit. Based on their belief that markets eventually become rational, they were convinced that by waiting for these distortions to correct, they could theoretically secure guaranteed profits. Major Wall Street investors poured funds generously into this brilliant group. Within months, an extraordinary $2.5 billion was amassed, an unprecedented sum for a hedge fund at the time. Their presence carried immense expectations as revolutionaries, bringing a scientific approach to a financial market traditionally reliant on intuition and experience. Indeed, the darlings of Wall Street, everyone believed LTCM would forge a new chapter in financial market history. Their journey began with brilliant success. For its initial years, LTCM indeed delivered astonishing returns. Profit rates exceeding 40% annually dwarfed existing funds. This success seemed to validate their mathematical models and strategy. Investors entrusted even more capital to LTCM, and the fund's scale expanded rapidly. LTCM fully leveraged its advantage in arbitrage trading, exploiting market inefficiencies. Their meticulous calculations accumulated small profits. Furthermore, by applying leverage, they transformed these small gains into explosive profits. Leverage reached up to 25 times their net assets. They not only used their own capital but also borrowed vast sums from banks to expand their trading volume. This allowed them to generate immense profits even from minor market fluctuations. This smooth growth instilled in LTCM's management and investors the conviction that they fully understood and could control the market. Their models were believed to be absolute. LTCM was hailed as the smartest group on Wall Street, and its success became legendary. This period of brilliance, however, concealed the signs of impending ruin. Yet, beneath this overwhelming success, danger signs began to emerge. Overconfidence in their models started to undermine their foundations. LTCM treated its mathematical models, based on historical market data, as infallible. However, markets do not always behave rationally, especially during crises when they move unpredictably. They had underestimated black swan incidents with extremely low statistical probability but devastating impact if they occurred. Moreover, immense leverage was a double-edged sword. While it amplified profits, it also carried the risk of rapidly ballooning even minor losses into colossal sums. In 1997, the Asian financial crisis erupted. Currencies plummeted across Asian countries, starting with Thailand, and an ominous atmosphere began to spread through the global economy. As market irrationality intensified, LTCM's models progressively faltered. Contrary to their predictions, market distortions continued to widen. However, LTCM's geniuses dismissed this abnormal situation as temporary. They believed their models would ultimately yield the correct outcomes. They further accumulated positions, stepping deeper into the quagmire. The more losses mounted, the stronger their attachment to the models became. But here, an unnoticed pitfall lay open. Within LTCM, the authority of Nobel laureates created an environment where dissenting opinions were difficult to voice. Their views were regarded as absolute, and no one could point out errors. Their past brilliant successes led them into the Concord fallacy. The psychology of being unable to turn back, having already invested so much, took hold. As losses grew, the sunk cost effect kicked in, the belief that if we just push a little harder, we can recover. This led to a vicious cycle of increasing risk. Even external investors believed LTCM's brilliant team would ultimately resolve the issues and continued providing additional funds. No one truly grasped the gravity of the situation. The risk management department became dysfunctional in the face of management's overconfidence and authority. Their warnings were ignored, and any voices questioning the model's premises were silenced. Furthermore, holding such massive positions meant they faced a dilemma. Even attempts to withdraw from the market would, by their very trades, move the market itself. With no internal checks and insufficient external oversight, LTCM hurtled towards ruin. The wheels of fate could no longer be stopped by anyone. Then, in August 1998, Russia declared a default on its government bonds. This event was a black swan that LTCM's models had not anticipated. Global financial markets plunged into panic, and the correlation between safe and risky assets completely reversed. LTCM's models utterly collapsed, generating colossal losses. Within days, LTCM recorded losses of $4.6 billion. A cascade of margin calls forced them to sell off their vast financial holdings. LTCM's collapse implicated many financial institutions that had provided it with funds, escalating into a systemic risk that threatened the entire global financial system. In response to this unprecedented crisis, the U.S. Federal Reserve, FRB, intervened urgently. To stabilize the financial system, they convened major banks to discuss a rescue plan. 14 banks contributed $3.6 billion, and LTCM narrowly avoided bankruptcy. However, this was an extraordinary bailout not by market self-correction, but through public intervention. The fund created by brilliant Nobel laureates left a deep scar on Wall Street, and its myth was utterly shattered. The LTCM collapse highlighted the limitations of mathematical models and the dangers of overconfidence. Markets are not always rational, and unpredictable black swans exist. Furthermore, massive leverage showed us it's a double-edged sword. It amplifies small successes, but simultaneously turns even minor failures into fatal ones. The groupthink and Concord fallacy within the genius collective teach us that even the most brilliant minds can have their judgment distorted by hubris and authority. LTCM's failure offers lessons relevant even in today's era of AI and data science. No matter how advanced a model, it becomes powerless if its underlying assumptions crumble. We must always remain humble, implement thorough risk management, and never neglect preparation for unpredictable events. That is the most crucial lesson to learn from this historical failure. Why did these geniuses fall into the trap of success? It was due to overconfidence in mathematical models and the double-edged sword of leverage. Who overlooked what? Market irrationality, fluctuating correlations, and the emergence of unpredictable black swans. What are the lessons for modern finance? Humble risk management, recognition of model limitations, and building an organizational culture free from hubris. The tragedy of LTCM continuously challenges our decision-making processes, reminding us that past successes can sometimes lead to future failures. Between those who understand this failure and those who do not, the quality of decisions made in today's complex world will fundamentally differ.
この失敗は歴史のほんの1ページ。世界にはまだ語られていない失敗が数多くあります。失敗の歴史をチャンネル登録して次の物語もぜひご覧ください。